On the 10th day of May, the threat of a perilous U.S. debt default and economic crisis loomed large, aggravated by the further tightening of credit conditions. This created a detrimental impact on the U.S. dollar and bonds, instilling anxiety in investors and markets alike. In parallel, the latest data released by the U.S. Bureau of Labor Statistics revealed that the Consumer Price Index, CPI, increased by 4.9% YoY in April, which, although slightly lower than the anticipated projection, was still concerning. Furthermore, the CPI continued its deceleration trend for the 10th month in a row, adding to the ongoing worries of the economic climate. Following this news, the possibility of the Federal Reserve raising interest rates by 25 basis points in June dwindled from 21% to 14.2%, much to the dismay of market participants. This situation quickly manifested in the U.S. dollar index, which nosedived by more than 30 points in the short term, whereas spot gold witnessed a sharp rise of about 15 points in the same duration. The yield on the 10-year US Treasury bond also plummeted by 58 basis points to 3.464, underscoring the gravity of the situation. The renowned investor Jim Rogers opined that the U.S. financial market is facing a graver threat than the 2008 financial crisis, primarily due to the towering debt problem of over $30 trillion. Additionally, on the same day, the White House and Congress resumed negotiations to prevent a months-long debt crisis, which would create history as the first default in U.S. history. However, the negotiations proved to be futile and lasted less than an hour, with significant differences and no progress made. Although the U.S. House and Senate have declared that they will continue negotiations in the following week, both sides remain adamant in their stance, displaying a reluctance to compromise. Even if more time were available for negotiations, it is uncertain whether it would be possible to reach a permanent debt ceiling solution. Both sides have emphasized that the U.S. has never defaulted and will not do so in the future, but the White House has not ruled out the possibility of invoking the 14th Amendment to the U.S. Constitution to declare the debt ceiling unconstitutional. The U.S. Treasury Secretary, Janet Yellen, has warned that failing to raise the federal debt ceiling could lead to dire consequences, including the possibility of a constitutional crisis, economic and financial disasters. Without the ability to borrow more money, the U.S. federal government may run out of cash, thereby risking default. To avoid the possibility of default, Yellen has suggested that unprecedented measures may need to be taken. Some members of Congress have proposed minting a $1 trillion coin that could be deposited into the Federal Reserve and used to pay off debts owed to countries like China. However, Yellen has rejected this plan, causing concern among Wall Street markets about potential bank turmoil and high interest rates. White House economists warned that long-term default could plunge the U.S. economy into a deep recession, causing a spike in unemployment and destabilizing the U.S. financial system, which is predominantly based on U.S. government bonds. This would create further shock waves in global financial markets. If a more severe default were to occur, it could lead to a sharp drop in the value of the dollar, seriously weakening its status, and result in a surge in oil and other commodity prices. The situation could even escalate into a black swan event, thereby becoming the third U.S. dollar crisis, causing severe upheavals in the financial markets. Bernard Yares, an economist at Moody's, has released a report on May 10th comparing the current debt standoff to the 2008 U.S. financial crisis. The impact of this crisis has shaken the creditworthiness of the U.S. economy and has left investors questioning the value of U.S. bonds as the cornerstone of the world's financial system. This development could further damage the reputation of the U.S. Treasury market as the safest and most liquid asset in the world. The agency is closely monitoring whether foreign central banks will take advantage of this opportunity to accelerate de-dollarization or continue to liquidate U.S. debt. Following the Russia-Ukraine conflict and the Fed's implementation of unlimited monetary easing policy and large-scale asset growth, the global de-dollarization trend has suddenly accelerated. According to the latest report from Goldman Sachs analysts, the number of reports on de-dollarization has increased this year, and some important events have occurred. This trend is weakening the global status of the US dollar, even surpassing the situation during the Russia-Ukraine conflict at the beginning of 2022. Elon Musk pointed out that the dollar is being overused as a tool to limit the economic and financial systems of other countries, which makes other countries want to abandon the dollar. Currently, More and more countries are considering settling transactions using non-dollar currencies, particularly more than half of the world's economies, including China and US allies, are gradually accelerating the dollarization, which weakens the position of the dollar in the global economy. China is currently leading the trend of de-dollarization, especially in 5 key areas, namely local currency swaps, oil currencies, digital currencies, selling off US bonds, and increasing gold reserves. China is accelerating the dollarization in these areas. Meanwhile, the abuse of the dollar and the irresponsible monetary policy of the Federal Reserve further prompted US allies to start turning away from the dollar and toward other currencies, especially in the field of commodity trading, which is particularly evident in the US bond market and oil currency area that support the dollar's currency status. Recent reports indicate that China is accelerating the dollarization, which has caused changes in major global economies. For example, Pakistan is purchasing Russian oil with the yuan, and the first batch of 750,000 barrels is expected to arrive at the port in June. Currently, Pakistan and China have signed a currency swap agreement. In addition, India may also start using the yuan to purchase Russian oil because Russia refuses to accept the Indian rupee as the payment currency for oil purchases. Other emerging countries and oil-producing countries, such as Russia, Iran, Brazil, Iraq, South Africa, Argentina, and Bangladesh, as well as developed countries such as Germany, France, and Israel, are also accumulating yuan reserves and beginning to use the yuan for trade. In fact, the proportion of yuan in the Russian National Wealth Fund has increased to 60%, and the share of yuan in Iran's foreign exchange reserves has also exceeded 22%. These countries' interest in the yuan also indicates their lack of trust in the US dollar and the euro. Therefore, these countries are also exploring the establishment of a common currency system with other countries to avoid the influence of the dollar. Brazilian President Lula once raised a question in a speech: why must all countries trade based on the US dollar? Why can't we trade based on our currency? This has also sparked calls from Brazil for China, Brazil, Russia, India, and South Africa to jointly establish a currency system to reduce dependence on the dollar. Malaysia announced that it would stop using the US dollar for transactions and choose the yuan as the settlement currency. Argentina and Thailand have also announced that they will stop using the US dollar to pay for goods imported from China and instead use the yuan for settlement. China, France, and they have already completed their first liquefied natural gas trade using the yuan. The yuan is gradually replacing the US dollar as the main settlement currency for international trade. This shift marks a significant turning point in the global financial landscape, as countries seek alternatives to the dominant position of the dollar. In conclusion, the de-dollarization trend, led by China and echoed by an increasing number of countries, is challenging the dominance of the US dollar in the international financial system. The repercussions of this shift extend beyond economic factors and touch on geopolitics, trade dynamics, and global power structures. As the world adjusts to a new currency landscape, the implications for economies, markets, and the balance of power will continue to unfold, shaping the future of international finance.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.